Hello and welcome to my channel. If you have not subscribed yet, hit subscribe and notification icon now. And never miss out on our new videos. In this tutorial, we will cover the basic approaches to investing in stocks. There are many approaches to investing in stocks, but here are some of the most common. Value investing, growth investing, dividend investing, index investing, and active investing. Let's look into each approach in details with examples. Value investing. This approach involves buying stocks that are undervalued by the market. The idea is to find companies that are undervalued relative to their intrinsic value and buy their stocks at a discounted price. An example of value investing would be if an investor identified a company that they believed was undervalued by the market. They would then do research on the company to confirm that it is indeed undervalued and has strong financials and growth prospects. Once they have determined that the company is a good value investment, they would buy its stock at a discounted price, with the expectation that the market will eventually recognize the company's true value and the stock price will increase. For example, let's say an investor believes company XYZ is undervalued by the market. They do their due diligence and find that the company has a strong balance sheet, reliable earnings, and a competitive market position. The investor decides to buy shares of company XYZ at a price that is below their estimated intrinsic value. If the market eventually recognizes the company's true value, the stock price could increase, resulting in a profit for the investor. It's important to note that value investing involves a degree of subjectivity and requires investors to make informed and educated decisions about a company's true value. There is no guarantee that a stock will increase in value, and value investing carries the same risks as any other type of stock investing. Growth investing. This approach involves buying stocks of companies that are expected to grow at a faster rate than the market average. These companies may not necessarily be undervalued, but their strong growth prospects make them attractive to investors. An example of growth investing would be if an investor identifies a company that they believe has strong growth prospects. They would then do research on the company to confirm that it has the potential for significant growth and is well positioned to take advantage of market opportunities. Once they have determined that the company is a good growth investment, they would buy its stock, with the expectation that the company's growth will drive an increase in the stock price. For example, let's say an investor is interested in investing in technology companies and believes that company ABC has strong growth prospects due to its innovative products and expanding market share. They do their research and find that the company has a history of strong revenue and earnings growth, and that it has a solid management team and a strong competitive position. The investor decides to buy shares of company ABC, with the expectation that the company's growth will drive an increase in the stock price. It's important to note that growth investing involves a degree of risk, as there is no guarantee that a company will continue to grow at the same rate in the future. It's also important to diversify your portfolio and not rely too heavily on any one company or sector. This approach involves buying stocks of companies that regularly pay dividends to their shareholders. These dividends can provide a steady stream of income for investors. An example of dividend investing would be if an investor buys stocks of companies that regularly pay dividends to their shareholders. Dividends are payments made by a company to its shareholders, usually in the form of cash or additional shares of stock. For example, let's say an investor is interested in generating income from their stock portfolio and decides to focus on dividend investing. They do their research and identify several companies that have a history of paying dividends and have strong financials. The investor decides to buy shares of these companies, with the expectation that they will receive regular dividend payments. In this scenario, the investor is not necessarily looking for capital appreciation or an increase in the stock price, but rather a steady stream of income from the dividends. Dividend investing can be a good option for investors who are looking for a source of income from their investments and are comfortable with a potentially lower rate of capital appreciation. It's important to note that dividends are not guaranteed and can be reduced or eliminated at the discretion of the company's management. Dividend investing carries the same risks as any other type of stock investing. This approach involves buying a basket of stocks that represents a particular market index, such as the S&P 500. The goal of index investing is to match the performance of the overall market, rather than trying to outperform it. An example of index investing would be if an investor buys a fund that tracks a particular market index, such as the S&P 500. The S&P 500 is an index that consists of 500 large publicly traded companies, and it is widely considered to be a benchmark for the overall stock market. An investor who buys an index fund that tracks the S&P 500 is essentially buying a basket of stocks that represents the index. For example, let's say an investor is interested in investing in the S&P 500 but doesn't want to individually research and select each of the 500 stocks in the index. They decide to buy an index fund that tracks the S&P 500. By buying this fund, the investor is able to gain exposure to the 500 stocks in the index in a single investment. The goal of index investing is to match the performance of the overall market, rather than trying to outperform it. Index investing can be a good option for investors who are looking for a low-cost, diversified way to invest in the stock market. Active investing. this approach involves actively buying and selling stocks based on market conditions and individual company analysis. Active investors try to outperform the market by making informed and timely investment decisions. An example of active investing would be if an investor regularly buys and sells stocks based on market conditions and individual company analysis. Active investors try to outperform the market by making informed and timely investment decisions. For example, let's say an investor is interested in the healthcare sector and believes that a particular pharmaceutical company, company DEF, is undervalued by the market. They do their research and find that the company has a promising pipeline of new drugs and is financially healthy. The investor decides to buy shares of company DEF, with the expectation that the market will eventually recognize the company's true value and the stock price will increase. However, the investor is also monitoring the market and the company's performance closely. If they notice that the market is starting to turn bearish or that the company is facing unexpected challenges, they may decide to sell their shares of company DEF in order to minimize their losses. Active investing requires a significant amount of time and effort, as investors need to continuously monitor the market and individual companies in order to make informed investment decisions. It also involves a higher degree of risk, as there is no guarantee that an investor's investment decisions will be successful. No matter which approaches you choose, it's important to do your research and understand the risks involved in stock investing. It's also a good idea to diversify your portfolio by investing in a mix of stocks, bonds, and other assets. Thank you for watching. Hit like and subscribe. See you next time.